We are here to discuss using real estate to reduce tax exposure and build a diversified portfolio with a steady income stream. My name is Brian Kirby. I'm the lead on the advisory team at Alfonso Wealth. I have over 20 years experience in advisory. I began my career as a retail advisor with Merrill. After a few years, I moved to the institutional side where I worked on mega corporate plans. As one of the servicing managers on the Apple plan, as well as government 457 plans, 403B nonprofit planning. I also have extensive experience in executive benefits and liability planning, so non-qualified deferred comps, ISO, RSU planning as well. And just to give you a little background, Alfonso, we provide a comprehensive wealth management solution. So we utilize a hybrid approach. It's more akin to a family office, and we are a registered investment advisor. Our goal today is to share insights that have worked specifically for our clients and answer any questions at the end of the presentation that you may have. And you'll notice there is a Q&A spot. So at any point in the presentation, if you have a question pops up, just put it in there and we'll address those at the end. Okay, so many of our clients are currently using real estate to build wealth and diversify their portfolio. And we've implemented these strategies with hundreds of people, just like you guys on the call today. One of the biggest challenges that our clients face are going to be time, expense, and then, of course, expertise. So as part of our platform, we have employed CPAs and real estate advisors right on staff to help us manage some of these problems. We'll try and keep this practical, so focusing on real world applications. And by the end of the webinar, you will walk out with actionable items for real estate investment and tax strategies. Joining us today as our speaker is Rupesh Goyal. So Rupesh has over 10 years experience in portfolio and hedge fund management, where he managed assets in excess of 300 million, consistently beating benchmarks. He has an MBA from the Carroll School at Boston College, is an active member of the CFA Boston community. So we want to make sure that we keep the session interactive. So put those questions at the bottom at the end. We'll answer all of those for you. So thanks for joining us. Let's get started. Rupesh, over to you.
Thanks a lot, Brian. A very good afternoon or evening to everyone, and thanks again for joining in. The goal of today's webinar is to give you guys a solid framework on how to use real estate investments as strategic financial tool so that you can reduce your taxes, generate income, and create long-term wealth. So let's get started with the story of one of our clients, and let's just call him Jim for now. So Jim is a senior executive at Amazon with 600K household income. That firmly puts him in the 35% tax bracket. His net worth is around $1.8 million, but almost all of his portfolio is concentrated in equities and is heavily tied to his employer stock, which is Amazon here. He's paying more than 150K in a year in federal taxes alone, which is a massive tax drag for him. He also have a chunk of cash sitting idle, which is earning less than 2% for him after taxes. Now, what does he want? He wants to find ways to reduce his taxes, and he is also looking to get into the real estate market to diversify away from equities. So what he should be doing here, and how many arrows do he need to hit these two birds? That leads to us to our agenda today. So we'll start with why investing in real estate is a strategic choice for him, and that is the only arrow he actually needs to hit those two birds. Then we'll move into what we call as strategy stacks. We'll break it down into 4 key approaches, which we believe works best, which are the short-term rentals, which is for active income and tax advantages, passive rental for stable and long-term wealth building. The third is real estate professional status to unlock significant tax savings. And finally, specialized funds to gain some passive exposure in the real estate. And finally, we'll summarize all this so that you have a clear picture on how each strategy can fit into your needs. So let's get started. Why real estate and why now? So there are several reasons for it. One, we are in a very interesting window right now. Certain real estate markets are still very much mispriced. All are lagging, unlike the post-COVID market, which we saw was clearly booming. One of the big reasons for that is higher interest rates, which have been the case since the 2022. And once the rates go down further than what they are right now, the markets are likely to pick it up again, and there are clear signs of the same. Second, for tech employees, especially, diversification is not just optional, it's very, very critical. Most of people have too much exposure to one particular company or in general to a geography for the equity market, which have done well over the past few years, but it's always critical to adjust your risks, which can be done via diversification, as we are seeing right now with markets melting. Third, with the recent passage of one big beautiful bill, tax strategies such as bonus depreciations are back. What that do is it makes real estate extremely powerful tool from tax standpoint. And lastly, a consistent and steady tax-free potentially stream of income generation aspect remains in this market, even when the conditions are not good. Let's start with the first strategy, which is called short-term rentals. This is like an Airbnb style model. With STRs, you're not just owning real estate, you are effectively operating a small hospitality business, which opens a door to unique tax advantage situations, such as bonus depreciation on the property on the very first year you purchase the properties. What makes these STRs interesting is that this sits between the real estate and business, as you are not just owning a property, but you are actually operating it to a certain extent as well. In all, what that means is you can generate strong income, unlock tax benefits, if, of course, structured efficiently and properly. So let's look at in details what are the benefits and the risks we are talking about with STR. One of the most powerful tax advantage here is the bonus depreciation on the property. What that means is that you can deduct all the value of the assets that qualify for bonus depreciation in the very first year of the property purchase. This could be most tangible equipments like refrigerators, washing machines, those kinds of things. These depreciations can then actually reduce your W-2 income as well for the taxable bracket, and that creating a strong tax tool for deductions. What's the best part? The deductions that you get out of these are actually higher than the down payment you would eventually do to purchase this property. On the other side, you also generate significant income from these short-term rentals, especially if you are able to kind of locate high demand locations and if you execute the plans efficiently. If you are concentrated in equities, this also creates an opportunity for portfolio diversification for your assets, along with a consistent income stream from these rentals. Risks. This whole process can be operationally intensive. And what we have seen over the past few years is two identical properties in the same market can perform very differently depending upon the execution. So operations smartly becomes a very key aspect here. And also there is a risk in terms of the demand fluctuations and that may happen inside that particular market. And in general, real estate market declines if were to happen. So what's the checklist in terms of what things you need to get it done right to make it work? And that it's still a long checklist, but that's why we think of it as a system, not just a transaction. On top of that, every decision that you take here can have a compounding effect. So it's very important to kind of execute them correctly. So the first one comes in the market selection. It's very important to pick the market which is right based on your needs as well as what the market is requiring in today's world. The second is financing structure. What's the interest rate? What's the terms? That becomes pretty important as well. Then the design choices, how you want to kind of design the overall property to make it more attractive. Then it's operational setup. How do you want to do the listings? How do you want to execute the overall efficiencies in terms of the cleanings, in terms of turnovers, those kinds of things. And finally, how all this comes into your tax filings. So all those things are a very critical checklist that you would need to eventually check in to make it work. And on top of all of that, your level of involvement actually also determines your tax outcome. For instance, you need to spend at least 100 hours on paper to be eligible for active tax deductions that can offset your W-2 income for tax perspectives. So this is where we have seen a lot of DIY, which is do-it-yourself approach, don't work because it's easy to optimize one or two pieces, but doing it the full stack becomes very hard. That's why we believe working with professionals here becomes pretty significant. Let's do case study to see how it worked for Jim here while working here. So we started with his preference. He wanted a property in the mountains so that he could enjoy it one day himself as well, as he was a big fan of that particular geography. So we helped him identify the location that was ideal for it and helped him finalize a property, which turned out to be a ski resort called Ludlow in Vermont. Then what we did was we helped him unlock the capital without triggering any capital gains in taxes because he still needed some money to kind of raise so that he actually could invest without taking any tax hit as well upfront. Then we also find him the right set of financial people who can provide him the best lending rates and then eventually close the property, finding someone to execute on his blueprints and property upgrades that's needed. We connected him to the right vendor as well. And once everything was ready, he decided that he didn't have time to operate himself, given he was a full-time worker as well. So ultimately, we needed to find him the right set of team as well to take the care of operations post-listing. So how does all these numbers stack up? Because it seems like he might be paying a lot, but it's not. So in terms of the property value, it was actually 500K. That was the worth of the property, and he paid 100K in the down payment, and there was another 80K in the home improvements that he had to do. How does that help him? In the year one, through the bonus depreciation, he saved straight away $75,000 in taxes, which would have just gone to IRS if he hadn't done anything. Second, he generated roughly 100K in revenues and 40K in net income after all the operating expenses. But most importantly, he converted a tax liability into income generating asset for himself. He also diversified out of equities. He also built a long-term legacy asset, something which he took pride in, and he could one day pass on to his children as well. That shift, we call it as real wealth. So let's get to the second strategy, which is called passive rental strategy, which is much common, but is less tax friendly. So in this, what you do is you purchase a property, find a long-term tenant, which results in predictable income and lower involvement. But there is a trade-off with it. The IRS classifies these activities as passive. What that means is even if you generate losses out of it, you typically cannot use against offsetting your W-2 income to reduce your taxes. Instead, those losses get carried away in your future tax filings, which can be used to offset your passive income only. So what are the benefits then we are looking at it? So the key benefit is obviously lies in the simplicity in implementing this, something like this. In addition to that, you get diversification, you generate income, and you have a potential of property appreciation, which is capital gains as well as the time progresses if the geography and the location is right. And most of all, the income that you would be generating is gonna be tax-free if obviously structured very efficiently. How can you do that? There is a thing called again bonus depreciation, which you can actually do it for your passive rental as well. What it does is again on the year one, you should be able to take a lot of depreciation out of your property purchases. While you won't be able to offset all the losses, with time, when you keep generating the income out of this, you should be able to offset your gains or your income out of it, which helps you to not pay any taxes while this income keeps getting generated. And over time, those deferred losses can still become valuable because if you exit this particular property, those would be released and then you would be able to offset your W2 income. So think of it as low friction entry point into real estate, but still effective, if you structure it very efficiently. So how did Jim implemented something like this? So the first thing is again identifying the property that aligns with his goal, which was stable cash flow, long-term appreciation without any requirements of his involvements. Again, roughly the value of the property was 500K. Second, help him unlock without triggering any capital gain taxes, so that he could actually invest without taking any capital, without any tax hit. Third, structuring the financing deal to get him best possible interest rates and the terms around his finances. And this is where it gets powerful. We also needed to execute a cost segregation and bonus depreciation method for him, which allowed him to offset a significant portion of his income that he can use for the future prospects. So out of the 500K property which he purchased for and he paid 100K, 150K bonus depreciation could be done out of his property. The end result, Jim now has a stable passive income stream without any taxes. Better diversification is there outside of his tech investments. And he has a structure that can potentially keep a large part of his passive income tax free for almost 15 years. So let's add another layer to passive rental and how we can make it active as well. So that's where the status called real estate professional or rep comes in. It is a very powerful structure. It is a status that can be designated to you if you do a very rigorous active management of your properties. It's a very useful tool if, let's say, you are in a higher earning tax bracket and has a very high, large kind of tax liabilities. And if you have one of your spouses who have actually time to manage multiple properties because it's a kind of a time intensive activity. In short, this is about changing how IRS categorizes your activities, and that's where it comes in from being passive to active. So, what are the key benefits associated with it? The biggest one is if you classify as a REP, then whatever the losses via bonus depreciation, any other expenses you incur, they are no longer passive, they become active, which means now you can offset your W2 income, your RSU income, or any other business income with these losses. So instead of deferring those benefits which you were doing in a passive rental, you are actually now pulling them forward and using it to your advantage earlier. The other benefit still remains the same. You still are generating rental income, you're still diversifying, and there is a potential to increase your capital gains through property appreciation. So how can you become an REP? On paper, the first thing you need to do is devote 750 hours in a year to manage those properties. So let's say if we count 220 days as a kind of working days, you're looking at 3.5 hours a day minimum to kind of manage the properties. And on top of that, more than 50% of your working time here should be going if you are working elsewhere too. So you cannot spend more time than you are spending here to work anywhere else. So basically, it's based on actual work, not the kind of just ownership. In terms of activities, what are we looking at? Those are tenant management, leasing management, any kind of repairs, vendor coordinations, and property oversight. The good part about that is obviously if one of your spouse can be a RAP, so that applies to all your household properties and all your taxes and all your household income. And what we have seen over the past few years, typically three or more properties makes the qualification more practical. Anything less than that, things become very, very hard to kind of show on paper that you need actually 750 yards to manage this property. So let's look at the last approach, which is called specialized funds. So here, what you're doing is you are essentially outsourcing the entire process of real estate management to professionals who who does all the operations. So you're investing in deals that are typically not accessible easily and to individually in the market. What they do is they handle all the parts like sourcing, executions, operations, and then eventually exiting from the property. So from your perspective, it's just like investing in a stock market. You invest, you get the income, you get the tax benefits, and that's it. So these are generally structured in a way that you need to hold it for at least 5 to 7 years, and there is a frequent distribution of income coming out of it, which could be monthly, quarterly, which often starts the same year you kind of invest. And the structure for these are pretty much like a LPGP, which is limited partner and general partner breakdown, where you are being a limited partner and there are operators who actually run, manage, and execute all this are the general partners in this particular project. The strategies here could be a pool of STR focused properties, which these guys are managing, or this could be value added multifamily homes, or this could be commercial properties or warehouses. So, what are the key benefits associated with funds like these? So, the key concept here involves is execution quality. If there is execution quality, only then we are looking at these things. So the first aspect is obviously the income generation. They generate a fixed cash flow annually, which could be in the range of 6% to 10% annually. And in terms of the overall return, we are looking at roughly 15%, given there is a property appreciation and there is a tax benefit associated with it. So how is the tax efficient benefit happens? So there is a bonus depreciation generally built inside the deal. So how you are looking is when these deals are structured, you would also be getting bonus depreciation associated with your investments that will help you offset any passive income associated outside of this business as well as this investments. So let's look at a real world example to see more clearly in terms of how these are structures and how it will help you. So in this case, Jim decides to invest. Sorry. So in this case, Jim decides to invest 100K in real estate. So the key here is again to find the right set of people who have run these projects before and who have the past experience of generating strong returns. So once invested, he was able to generate $36,000 in bonus depreciations upfront from this 100K. Um, Again, another thing which is important is to manage taxes in a way that he gets those $36,000 in his tax filings. So that 36K is going to still say in his taxes. If there is no 36K worth of passive income, he can carry further, and he don't need to pay taxes on any passive income that's offset it. On top of that, he's now steadily receiving 7.5% in income, which is again shielded by taxes, which he generated in bonus depreciation, so there is no tax on that. And finally, he stands to receive around 14% in total returns after tax appreciations and income generations because of the quality of the project he kind of invested. Again, the key involved is finding the team that has the execution quality to do it. So stepping back, so what we know that is at higher income levels, the game changes. So it's not just about earning more or picking better investment. It's about how your incomes are structured, how your assets are allocated, and how your taxes are managed efficiently. And this is where real estate sits at the intersection of all these three. And when this is done correctly, it just doesn't then generate the returns for you. It also improves your entire financial system through tax optimizations as well. So if you're looking to offset, let's say W2 income, mostly things like SDRs and REPs is something that would work for you. Versus if you're looking to diversify only, invest in real estate, and have tax-free income from things like passive rental and specialized funds. These are the tools that you can use to kind of do those things. The goal here is to reach the level of tax efficiency where IRS would look at your portfolio, feels bad for you, and must offer to start GoFundMe on your behalf. With that, I'll pass on the mic back to Brian for the Q&A session.
Thanks again, Rapesh, for breaking all that down. Now, we've covered a lot of ground today, but due to time constraints, there are many topics we couldn't cover. Things like 1031 exchanges, how to rent part of your residence as a short-term rental, power of LLCs to hold multiple properties and receive tax breaks. We know that this is a lot to digest in one sitting, especially when you're balancing a full-time job. To make this actually useful for you, we put together a full slide deck from today and a recap video. So if you want to revisit any specific strategy, we're going to send that in an email after the call. We're also going to send this scheduling link. So, each individual has specific needs, and we want to address that on a one-on-one approach. So what we do is we tailor a customized solution to every client based on their specific situation. There really is no one-size solution fits all. It requires, in-depth planning, and that's based on the individual. When clients ask, essentially, when should I start doing this? Right away or yesterday is usually my answer. We've opened up a few one-on-one slots for the real estate planning next week. So we have those available to you. It's going to be a screen share. So we'll familiarize you with the Alfonso platform. We'll gather some information that are specific to your needs and plans. And after that, that's where the fun really begins, because that's when we'll start to develop a strategy that works for you, and we'll guide you step by step through that implementation. Now, again, you can see the Q&A button. So if anybody wants to add a question in, please do. So I'm going to get started now with the questions that have already been submitted. So Rupesh, our first question is, okay, is this strategy for tax reduction can be used with your own house, your own property?
So that's a tricky thing. You cannot use it for your own home. This generally works only in case of rentals. So what you can do is if you really want to execute something like this, maybe part of your home can be a rental property, and that's how you can execute some or part of these strategies and incorporate them in your financial plans.
Great. Now, what actually counts as a short-term rental?
So there are some technicals around it. So generally, it's considered a short-term rental if your house on an average has a turnaround of 7 days or less, and you are providing all the services that are associated within that particular period. So, for example, any kind of hospitalities like cleanings, like food to a certain extent, basic amenities. So those kinds of things is something that you should be kind of providing. So that counts as a short-term rental.
Now, what counts as 100 hours? Can I hire a property manager to do those 100 hours for me?
No, you don't. That's something you would have to do it all by yourself. You can still hire a property manager to manage your property because sometimes you need more than 100 hours to do it. But you still need to kind of devote on paper 100 hours to kind of run this property. Now, this can be to a certain extent, okay, managing that person who is actually managing your property, doing some research, visits every now and then to your property, those kinds of things. If you are doing, that should be more enough for you to kind of get into that 100 hour mark.
Okay, will bonus depreciation work even if I have a W-2 job and I'm not a real estate professional?
It will only work if you are running a short-term rental. So if you have a passive rental where you just kind of have a tenant who's living there for long term, then you can only offset your passive income. That is the income you are generating from that property. But if you are running a short-term rental, then it becomes actually an active income. And on that case, you should be able to offset your W-2 with this particular the bonus depreciations, basically.
When can I use the loss deferred in a passive rental?
You can use it whenever there is a passive income generation. So what we have seen is there are three sides of it. One, whatever the income that is generated from this property, that is something you should be able to offset with these passive losses. Two, some people have multiple properties. They already have some properties which is generating profit. So they are able to offset income from those properties through these depreciation. And then third, finally, if let's say you were to kind of sell this property, then whatever losses that you have accumulated over time, then those gets released, and then you would be able to offset your W-2 losses with it.
Okay, how is this approach different from a real estate syndication as a passive partner from a taxation perspective?
It's very similar to that. I mean, the strategic investing, which is specialized fund, it's similar to that. So basically, you are not part of the syndicate as an active professional. You are like a passive investor in that syndicate. Basically, you have GPs who are running this particular kind of project, and all you are doing is investing in those particular projects. You believe in those people, you believe in that project, and through their operational execution, you are able to generate income through obviously rentals that they are kind of incurring. And then obviously, if they have structured it in a most efficient way, you are able to kind of generate those bonus depreciations as well. That will help you offset any particular taxes associated with this income or any other passive income.
Okay, so for real estate professionals, is that three rental properties, or would you include your own house in that count to meet and justify the 3.5
It
hour stay
has to
quota?
be three rental properties outside of your home. So it could be combination, let's say one short-term rental and one kind of, two other passive rentals or more short-term rentals. So generally we have seen short-term rentals needs a little bit more time of yours if you haven't hired a property manager. So higher the number of short-term rentals, the easier it becomes for you to be a REP.
So can you share insights on how you help allocate the initial capital gains without triggering additional capital gains?
Yeah, that's something we have seen this come often across. So generally, the best way to kind of do is find the lots. So for example, in this case, Jim had some of these Amazon stocks which were vested to him at a price which is pretty closer to what it is right now. So we are able to sell those, then we are not triggering any particular capital gain outside of it. Second, we are able to offset some of the losses via the gains that we may eventually have to make to raise the capital. So let's say again, he had some Amazon stocks which were vested at a lower price right now. So he's incurring any capital gains, but he had also some other assets at his disposal which were sitting at some loss. So we were able to kind of do tax loss harvesting and reduce his overall basically tax capabilities to kind of raise the capital.
Okay, so with 20% down payment and the rest on mortgage, what could the difference between short-term rental income, month or long-term rental income a month versus regular mortgage payments look like? For how many years?
Sorry, can you repeat it, Brian?
So with a 20% down payment
Hmm.
and the arrest on mortgage, what
Yep.
could the difference between short-term rental income for the month or long-term rental income for the month versus your mortgage payment look like for how many years?
Yeah, the mortgage payment is going to be very similar. It doesn't make difference in whether you're running a short term or long term. You get a standard terms, 30 years. I mean, today's market is around 5 to 6% interest rate. That's what you would get. So mortgage payment in terms is similar across those most of the times. The difference is in terms of the revenue that you would generate. Generally, with short-term rentals, we have seen um, that all depends upon what you kind of select, but we have seen most of the times it would generate higher revenue for you than compared to passive rentals. But there is more operations efficiency involved here as well and expenses involved here as well. So in terms of the net profit, in terms of the percentage, we are looking at passive to have a little bit higher because the operation efficiency is low. But in terms of final comparison, the bottom line, if we are looking at that is net income we are looking at, that's still a little bit higher in short-term rentals compared to long-term rentals, given you have the capabilities to do it efficiently.
Okay. Uh, I know you can defer capital gains on a property. If you use those gains to purchase another, is there something similar for capital gains on selling stock?
Selling stock, you said?
Yeah, it says I know you
No,
can defer
yeah. So
capital
that
gains
yeah,
on it.
so that's yeah, so that so they are talking about 1031 exchange basically. So basically, there you can kind of defer or don't incur any capital gains when you kind of invest in another property. But unfortunately, this is something the IRS doesn't allow for the stock market. So that's something is strictly there for the real estate market.
Okay. Does the one big beautiful bill affect these strategies?
Absolutely. That's why these have become more proficient and even effective after the OBBB because earlier bonus depreciation was actually not allowed and you were supposed to do very standard kind of depreciation. But for now, up until for the next 3 years, this is something is still gonna remain as part of the one big beautiful bill. So you should be able to take bonus depreciations for any property you purchase from now on for the next few years and take the benefit for years to come.
Okay, so we have an Alfonso question. So is Alfonso cost structured per session? Are you guys a fiduciary?
That's something you can answer it more than better than I can, but yeah, we are fiduciary. It's a flat fee structure. It's based on the plans are catered to based on your requirements. So once you pick up the plan, which works best for you, you're gonna be on that particular plan, without getting incurred any additional cost out of it. And yes, we don't take any commission outside of this. Everything we get, it's all from you. So we are 100% fiduciary.
Yeah, so we are a subscription-based model, and we're all fiduciaries. So we're never going to try and sell you anything. You don't have to send us any money, anything like that. It's a flat fee model that it's not plus plus plus. All the services are available to you. Okay, I'm if I'm on W-2 and want to get started with real estate, don't own any yet. What's the best way to go about it?
Yeah, I think that depends upon a lot of things in terms of what works for you. So it depends upon what you're kind of looking for. Are you looking for more involvement or are you looking for less involvement? Do you have time for more involvement? So if you have time, then maybe short-term rental is the best way to go. Versus if you don't, then maybe passive is the opportunity for you. Second, if you are looking to offset your W-2 income only out of to reduce your taxes, then passive may not be the right fit for you. Then you are definitely looking for short-term rental. Or maybe if you are looking for aggressive purchases of multiple properties, then maybe you are targeting an REP status. So it depends upon what you are kind of looking for. So yeah, active W-2, then probably STR is the way to go for you, basically.
Yeah, and just on top of that, I mean that's a deeper conversation. That's where we talk about we go into specific needs of the clients. How available are you? Capital requirements. So that's when that's going to be a much more in-depth conversation, and that's going to be based on the individual. What is required to claim bonus depreciation for rental property?
So that's something, a conversation with a CPA. So basically, they are the ones who would kind of arrange something like this. How it works is they would evaluate your property. They would find the things which come under bonus depreciation. They value those things, and then they kind of prepare your tax forms to include those particular things.
Okay, I'm not sure if I understand this question. If I bought a house prior to marriage, then get certified maybe 1 or 2 years later and get married, can I claim the loss defer after marriage as a household?
Sorry, can you repeat?
Yeah, it says if I bought a house prior to marriage, then get certified maybe 1 or 2 years later and get married, can I claim the loss deferred after marriage as a household?
I'm not sure. I also completely understand, but I think part of it I do understand. So basically, if someone didn't um, take any bonus depreciations before when they purchase the home, will they be able to do it now? If the question is around that, then yes, you still should be able to claim those depreciation back. But most likely, you won't be able to do bonus depreciation because that's something it has to happen in the first year of the property that you purchase or any kind of major redesigning, reconstruction that you did in that particular property. So if not, then you can still claim back regular depreciation of the asset, but it just won't be bonus depreciation, basically.
Okay. Does becoming a certified realtor help with any of this at all, tax and opportunity wise?
So yes, so if they are saying REP or the tax certified professional here, then yes. So once you are an REP, whatever bonus depreciation losses, whatever in general expenses that you have been incurring, all those gets into offsetting your W-2 income. So a lot of the times what we have seen is if you are an REP, there is a very, very, very strong chance that you end up paying nothing on taxes on your W-2. It's that powerful, basically.
Yeah. Okay, so that's the last question. I want to thank everybody today. Um, Great questions. We appreciate the input. And if you, when you get the email from us, it's going to have all the information on there. If you have any further questions, please just use a scheduling link. And I want to thank everybody for their time. And we look forward to continue the conversation and have a great weekend, everybody.
Thanks a lot, guys.